Welcome back to the podcast. My guest this week is Richard Adler. Richard has had a storied career in asset management and in REITs, spanning almost 4 decades. He was a co-founder of EII, a REIT specialized asset manager, which had phenomenal success. He's been an advisory board member of Armada since our founding, and he's been a friend and a mentor. So thank you, Richard, for your work with me and with Armada. He's got some amazing stories to tell about entrepreneurship, leadership, real estate, and business. Richard, thank you for joining the podcast.
Well, thank you, Phil. Thank you for having me. And I enjoy the entrepreneurship first and foremost. I think it's fun to think back, actually, and at your behest, putting all these experiences together. It has been fun, and I mean, and insightful. So I'm happy to share whatever tidbits might be garnered here.
There are so many things to talk about. I don't know how we're going to fit in to the time we have. But the amazing thing is there's so many parallels to things going on in the markets now, in the real estate markets, and things that we're doing as a business with Armada. It really, history doesn't repeat, but it rhymes. And I think we're going to find a lot of rhymes in this story. Let's start the story at the beginning. So you started EII in 1985?
No, actually, we started in 1983. And taking it back one step before that, I had spent 10 years at Goldman Sachs in the security sales department, and I worked in the international department. So from the beginning, I worked cross-border, and I developed a very close personal relationship with an individual, Christian Lang, who was German, had been at Goldman Sachs for 7 years, and was the founder of the Zurich office for Goldman Sachs. So I was working together with the Zurich office, and then he was hired away in the mid-'70s by the wealthiest family in Germany. They wanted someone who with a strong American background to invest in the United States to diversify them. The U.S. was both the top military and economics. That was sort of the combination of China and the economics and the military. And remember, Germany was a divided country in those years, so that it was strategic as well as economic to be there. And 7 years later, Christian came back and grabbed me to open EII. It was originally European investors with the notion of investing in the United States across asset lines on behalf of these very wealthy Middle European families who were used to the universal banking system. They didn't have the separation at the time between banks and securities firms that we had here during the era of Glass-Steagall that separated the two. And they liked the working with individuals, not with casts of thousands, which is often the case in they liked the confidentiality. Mm-hmm. So what we basically did is we invested across asset lines. Christian had done this for the family, and we included general equities and bonds, which was my background because of being in security sales. He had bought and sold over $1 billion of real estate, so we brought in a real estate people, and he had bought major pieces of American companies, so we had what we call corporate finance, what we would call today perhaps quasi-private equity. So we did all three, and two things were significant there. Number one, we were used to working cross-border. I say that because borders are not just geographical. Borders can be existing within industries. And there are very definite borders that existed in, if you look at real estate as one example, between the real estate world versus the securities world, especially at that time. Then there were borders within those worlds. And so the idea of working cross-border turned out to be a distinctive competence that we had that was different than most other advisors who know more and more about less and less. The other thing that I think is significant about that we were very experienced, both of us, in the financial world. When you think of startups, now maybe if you look in finance, it's less so. You see guys starting a hedge fund who've got years of this track record and what have you. But a lot of the startups today seem to be done right out of college. I don't know. I think that's a little hard to do in finance, but maybe it's easier in the digital world. But we were both very experienced with very high credentials, and this was a basis of building relationships at the time. Now, one other thing that's significant too, with the tax aspect, we were working with taxable investors. That adds a whole layer of complexity, but also opportunity in the investment set. In other words, not all investments are all the best for everybody. That's why you need an advisor to take the overarching situations and apply them to the specific situation of the investor. And there were issues both domestically and internationally of the taxes that were complex, poorly understood. Again, the fact that we had that knowledge enabled us to distinguish ourselves and to grow our business.
Yeah. Now, early on, right, things were humming. You were building from the beginning. Early on, you get hit with the recession of 1990. And it's funny because people talk about the global financial crisis, obviously. People talk about the dot-com bust. People talk the 1990 recession is, I think, largely forgotten or absent from the discourse today, this day and age. But it was a pretty big deal. And private markets were frozen. Sound familiar, right? Talking about things that history rhymes. Private markets were frozen. Tell me about the recession of 1990 and how it impacted your early business.
Well, we had started this very slowly, this process of looking at REITs, and I say that because really, you take us one recession further back, the 1973-74 recession, and that was a recession where the REITs had finally gotten people who knew what a REIT was. This is important to understand the effect of recessions on the development of the asset class or the type of investment called REITs. The original REIT legislation was passed, believe it or not, in the Eisenhower administration, the last year of the Eisenhower administration. And again, just for those who may not be as familiar with the REIT structure, the whole idea was to create a mutual fund of real estate, not of stocks per se. So a REIT had to own many assets. It had to that were real estate related. 75% had to be real estate related, which was broadly defined. It included both physical real estate, but also real estate finance. In other words, mortgages. But there's some detail as to be real estate related. The other really distinctive aspect of it was that, like a mutual fund, it was not taxed at the entity level as long as 90% of the earnings were paid out. This created a cash flow oriented, a yield oriented aspect of REITs and made them, potentially quite attractive to people looking for income. The REITs, though, unfortunately, the first ones that came out of the box in the late 60s and into the 70s were mostly mortgage REITs. They were much easier to do, much easier to administer. And what happened was all the bad mortgages on the sponsoring bank's books got put into these things called REITs and sold to the public. Well, they borrowed long, they borrowed short, lent long, they had all bad quality, and the things blew up in the 73-74 recession, and they turned the word REIT into a four-letter word. People got burned, and they didn't want to touch them. And it literally took a decade for these things to begin to be reconsidered. Ironically, there was one successful equity REIT from that era, General Growth Properties, and this was the Bucksbaum family out in Iowa, and they started to buy and build malls, which were the emerging retail technology of the time, in and around the growing interstate highway system. And that was a successful REIT because they owned equity. They didn't own debt. So they were the exception that proved the rule. Took 10 years, and we had gotten, and are working in these multiple sectors that I mentioned earlier, we'd gotten a mandate to put $100 million into U.S. real estate, broadly defined. And about that time, Salomon Brothers issued the first equity REIT in a decade. It was brought to the market by a fellow who was the head of Equitable Life Insurance, and he wrote a very profound question. He says, how come a building can't go public? He put 3 institutional quality properties into a REIT. He was able for the first time to project earnings on a forward look, which was just a changing regulatory environment. And he had spreadsheets like you'd look at a regular property. There was there was, a mall, an office, and industrial, and it was very real estate like. You could look at it as real estate. So I took it, and the other thing that was really interesting is he used a zero coupon mortgage, which meant that most of the dividends that were distributed were considered return of capital. I mean, this was financial engineering. Well, that happened to be very tax advantaged in Germany. So I took this, I respect this, I dropped it at Christian's desk. I said, here, if you want to buy some real estate, we can do it right on the floor of the stock exchange. We both knew the Bucksbaums and the General Growth because it had been a Goldman Sachs issue. And we convinced the client to say, okay, let us take 25% of your allocation into this new vehicle, this new thing. The best part of that story is I went to our then real estate specialist, a young woman named Sydney Donnell, who had come through the banking system in Texas in the early 80s, which was the debacle, and the real estate there was because of the oil crisis. And I said, here, would you please look at this? And she said, I'm a real estate person. I'm not a stock person, like an epithet. Well, it turned out she became one of the most significant figures in the real estate world because she learned how to be both. And that was but that was the essence of the character of these two areas. There was very little overlap. And so that's why we started to build this up when we invested. And then with this 1990 recession hit, Katie by the door, man. I mean, real estate was right at the epicenter. There have been a number of people that bought real estate as an inflation hedge because of the 70s. The private real estate that had mostly gone into these very leveraged tax syndications that got obsolesced in 1986 because of the change in the Tax Act. So they were allowed, we're failing. Then the institutional real estate had gone into these large funds established by several, including Goldman. And they all were promised 8% a year because of inflation. And guess what? It wasn't happening, and they blew up. There was no capital for real estate. If you had marked Citibank, because the banks were the other source of capital, if you marked Citibank's balance sheet to market, they were negative. I mean, it was a disaster. Now, why? To your point, Phil, people don't talk about it because most people who of that era have checked out. No, they've lived the tech wreck. They've lived the great financial crisis in many cases. And let's be clear, you're somewhat a product of your time, and those are your frames of reference. And cycles are very important because you learn more in the downside of what can go wrong than you necessarily do when things are going swimmingly. 100%. But that's why the 1990 recession was key, because there created an outer vacuum in real estate. And the question was, where is the capital coming from? And there was a funny story. I mean, people started to figure out, he says, you either go broke or you go public, because there was this thing called the REIT, and they all started to dig it up. Even though it's been around for 30 years, nobody had ever used it. Next thing you know, since we had about 50 million, that made us a player. And we had people like Sam Zell in our waiting room. And the idea was we were one of 3 or 4, maybe 5 serious investors. When I say serious, I mean working with very sophisticated clientele, whether institutional or high net worth, that were somewhat active in this space called REITs. And we became what became known as the REIT mafia. These IPOs, we would have one-on-ones, and we had the opportunity to discuss with managements what their plans were. That turned out that was critical for several reasons. Number one, all these managements had mostly been syndicators, and we spelled that with an I, S-I-N, not syndicate, because their language was interesting. It was first person singular, I this, I that. The distinctive difference was, we said, look, if you're going to manage this real estate and we're going to invest with you, We're going to invest with you, not from you. What did that mean? That means that the management was integral to the REIT. It wasn't an advisor with a pool of capital on the outside who got paid by the size of the assets he managed. It was we get paid by the performance of the real estate that we acquire, and that we may not only acquire, but we expertly run. So that very important point was that you have internal management, no conflicts of interest. Other firms like Cohen Steers was one of them, was very insistent on this. And I think because of this cadre of sophisticated and focused group, the REIT Mafia, we created some very important governance principles that turned out to be adopted broadly by the REITs that began to come public. And that's, I think, one of the main reasons that this group turned out to be successful.
Yep. So REITs started to take off in the early 90s. You said to me, competition defines a market. What do you mean by that?
Well, so this is also interesting because it gets into the behavior. Now, this again is somewhat more the institutional market, just its idiosyncrasies. If you're the only one telling a story, you are like what's the fabled, Greek mythology where the guy has got carrying the light and he's looking for truth, and he's trying to,
I'm thinking of Chicken Little, right?
Yeah, well, it's like you're all out there by yourself. And the problem with that is, maybe you've got some insight, but it looks a little idiosyncratic. The guy's a little nutty, and Well, REITs, again, especially at the institutional level, REITs had been invested to democratize, the ownership of real estate. It was considered a retail product. It did not have scale, did not have particularly liquidity. And so the idea that institutions would consider buying them was completely new thinking. Now, the gatekeepers for most institutional investors are consultants. We were not the only one telling this story. We had some 3 or 4 good competitors, and they were telling the story. And if the consultants hear it enough times, they say, well, maybe there's something here. It's not just one guy searching for truth out there. And that proved to be the thing. So what I make the distinction between primary demand and selective demand. Okay, the primary demand in this case was finally achieved when the consultants, people like Cambridge Associates, finally said, I think there's something here. And they said, we will recommend it. Then the question is selective demand. Who will we recommend? Now, the reality was there were 4 or 5 of us, and we all got a piece, okay? Now, that became, then it goes into the more traditional selective issues. What's your relative performance? What's your team? And this is the kind of things that consultants review in some depth. And they were all good and worthy competitors, and we got our shares. At one point, we got a hot streak. I think we won 13 out of 14 competitions, but it's because we had good performance. In fact, we outperformed every year for over a decade by 200 basis points. Now, why did we do that? Now, that's also interesting. In the early stages, as these companies began to come public, 2 things happened. Number one, you went from diversified REITs into industry-focused REITs, because in order to be really competitive, you had to know the particular characteristics of your real estate in your industry. So that was one of the changes. But then they were companies with different expertise. Sam Zell had his manufactured housing REIT. Steve Roth had his office REIT. The Simons and the Taubmans had their mall REITs, and you could compare the two. But the thing that turned out to be the critical variable in selecting the best REITs was not the property type, it was management. And I'd give enormous credit to my then colleague Sydney Diddell, because she, I don't know, she had some kind of antenna that she could be, this guy's real, this guy's not. We invested in 14 out of the 15 best performing REIT IPOs that came during this, what became known as the modern REIT era, as more and more of these companies became public. And we invested and we avoided the 15 worst. And the major distinction was who could manage effectively in a public forum. Now think of that. So when if you're a manager of a REIT, of a public company, you got to stand up there every 3 months and say, this is what we did, open kimono. Whereas, the traditional real estate business, it's a caveat emptor business. The guy who's selling it knows more than the guy who's buying it. And it's like, close to we don't want to tell. Some managements could make that transition and open kimono to 25-year-old analysts with spreadsheets, and some people couldn't. So that ability to be to function in a public market with disclosure turned out to be the distinctive variable in the early phases of the modern REIT era. Now, as these REITs came into market, they got bigger, they got more sophisticated. The survivors were those who had good management. And so that differential began to narrow. And in fairness, it began to take away our edge as from a performance standpoint. Again, you outperform every year, and then it gets harder and harder. And that's just the maturation of the business.
Right. Right. Well, they say time is a flat circle, and you did research back then in the 90s. You did research on the correlation of performance between what I call the private REITs, but what are more technically called the NAV REITs, or we'll say the NC REIF index, which is the broad private REIT index, versus the NAREIT equity index, which is the broad public listed REIT index. And you were able to manage for the difference. You were able to account for it. Tell me about that research.
Well, this turned out to be very critical. And again, it's not like we knew. It's just being there and dealing with the issues that came up. We had developed one significant institutional client, Siemens Corp. We, again, this is our German experience. We had helped them out in a very dicey situation and a particular REIT they had invested in. And so in exchange, they allocated, I think we had 50, something like 50 million. It was a huge number in those days as a separate account. And then all of a sudden, we learned, and this was pretty much in the early days of this modern REIT era, which formally began in 1993 with the IPO of Kimco Corporation, that their consultant was changing, and the new consultant thought that REITs were stocks. It's real estate. And we went panic. Oh, how are we going to fix this? So we asked our director of real estate research, the lovely woman, Ann Mengden, who was married to Michael Giliberto, who was a PhD from Harvard. At the time, he was at Lehman. And we said, Ann, you got to help. We got to be able to explain to this guy what's going on and how do we convince him? So the two of them apparently sat down over dinner, and it came, over at home. This is, this is what you do when you marry a PhD, I guess. But the point was, how could you reconcile the fact that there was very little correlation between the NACREIF, the National, it was I forget the exact what the acronym stood for, but it was the metric of these institutional funds that were very large, but they were based upon appraisals. And the REIT index, which was NAREIT, National Association of Real Estate Investment Trusts equity index, and they didn't correlate. It didn't. There was, and that's all.
It's now same as now.
Yeah, just two little lines. They didn't correlate, and so they wrestled with this, and then they realized that if you look at the process of how something is measured, not what they're measuring, And the appraisal process, which is the way the funds were in any private real estate, as a practical matter, is evaluated, is based upon comparable sales in the region or the area wherein the properties are held. Thereby, it's backward looking. A common stock, which is what a REIT is, I mean, what are the expectations? They beat expectations. They didn't. It's not. It's a forward-looking, and it's a discounting mechanism. Expectations, in turn, are a heck of a lot more volatile than realities, and sometimes we get excited about it. The point was they were looking at different time zones. So the research that the two of them did in 1994, I know this sounds like ancient history, but the insight was critical. Michael Gilberto delivered in successive weeks the keynote address at the NAREIT in the annual gathering, and a week later in the PREA, which is the Pension Real Estate Advisors meeting, same address. And basically it said, when we adjust the time difference for these two indices, we get a 95% correlation. Ergo, it isn't what it is, it's how it's measured.
Yep.
Now, that's still an important distinction, but the point is, it's ultimately it's real estate, and at that point in time, Priya and NAREIT were at loggerheads with each other, and then they said, "Oh, I see. Well, we're really two sides of the same coin," and they became far more cooperative. But that was seminal research, and it came. The catalyst for it came from our specific experience. I'm not saying we did it, but we catalyzed the research, and those lessons still apply. To your point, what we've just been through here with BREIT is a good example. It's a later form of non fully traded real estate, but it's still the same phenomenon.
Yep. Yep. So, kind of fast forward a little bit, REITs go international. The AUM at EII peaked at $14 billion. The REIT industry that started at $10 billion when he started, you were right there at the beginning, had matured to $2 trillion. What changes were there in the industry? How did the industry change and evolve, and the kind of good and bad ways as it grew to full maturity?
Well, first of all, the idea we had already worked cross-border, as I mentioned, and this time geographical borders.
Mm-hmm.
And again, just to point out what why that before I go into how things evolve, but also understand why this notion of cross-border is germane. The borders of real estate versus equities or common stocks was different language. It was when we measure REITs, we talk about FFO or AFFO, which are funds from operations, or the the amount that can be distributed, and not the FFOs, because you got to allow for depreciation and reinvestment, as opposed to or internal rates of return, IRR. These phrases were different than earnings per share or PE ratios, which were stocks were. Now, so the language is different. Now, it's all based on the time value of money, underlying economic analysis, but the phraseology was like speaking a different language. The career paths were different. The frames of reference, a stock can be overnight, maybe it's out a few months. A building was decades. So they just didn't think there were two separate worlds. That's a border. What did the REITs do? Well, they were taking this asset and they were distributing it through the channel, the channel of distribution of the public securities markets. Okay, well, if for no other reason that you're distributing this asset through that channel, it's going to take on certain of the characteristics of other entities being distributed through that channel. So that created this distinction it began to blur the lines between these two in these two asset classes.
Mhm.
Because distribution channel is also one of the big differences in how you define asset class. If you look at the distribution channel of commodities versus stocks, which is, you can say, I've said it's a different market than you bring futures and stuff. So these markets during my career began to blur because of the, and that was financial technology, quite frankly. That was part of the opportunity. Well, the other borderline that we talked about was the international borderline. And we had looked in the early 90s, because of our experience overseas, we said, well, maybe we should do real estate internationally. And when we looked at the handful of international REITs, real estate, they were mostly C Corps, in other words, taxable corporate entities. They were small, very highly leveraged because it was hard to get equity. It was really easy to get that. Very volatile. They were like airline stocks. You traded them, you didn't own them. And we concluded that that was different than what we were doing in the US. But we waited, 6, 7 years, the end of the 90s, and we said, someday this is going to go global. And that was the trend in general. And so we said, we brought in an individual who had some experience doing this and great frustration in trying to. And we said, look, you build the team, we'll handle the administration, and we should start to do this international real estate. But we did it as a separate pool. I wrote a paper, and we wrote a paper, I think 2002. We said, this REIT structure is going to be adapted overseas because it works so well in the US. 3 years later, one of the consultants writes a paper that says, we're going to, we think REITs are going to spread. And they did. And REIT got involved, and there was a REIT-like vehicle in Australia, but all of a sudden, the REIT structure, this idea of a real estate related, got to pay out your cash flow or your income, not taxable at the entity level, spread all over the world. And that created a new industry. Well, we were one of the innovators. We were one of the earliest ones. We had good performance in that area. My colleague Sidney Dindell had retired in the early 90s, became a professor down at Texas A&M, had a very distinguished career in doing so. But the point was, our performance suffered somewhat on the domestic side, but we were very good still in the international. So we rebuilt. We did it twice. Okay, we outperformed and built our twice. And then in 2005, we developed a global. I was part of our mutual funds, and I said, it's only a matter of time before the institutions are going to say, I can't decide if domestic is better than the international. Just do them together. You decide.
Yeah.
So that's when the whole notion of global REITs came of age, and it got cycle tested during the great financial crisis. And we were one of the leaders. Now, we weren't the only ones. In any industry that grows like this, you can imagine you attract a lot of competitors, very good ones, very big ones, and so the ability to outperform became more and more challenging over time. But if you go back to David Swenson and his sage advice as the manager of the Yale Endowment, when an industry is young, you want to be an active investor, but the more mature it gets, you go passive. And that's what had begun to happen in real estate. So that was why when we went through the financial crisis, we fared well. I mean, just to give you an idea, when I say fared well, I mean, the firm fared well. We never laid off anybody. We were, the NAREIT index went down something like 80%. The domestic index, it recovered, but the point I'm trying to make was that we had a deep team and a very loyal, paternalistic almost management style. We felt very responsible for our people, which was not, and in building a business that, to your point, is one of the things that needs to be considered. Now, in the crisis, the volatility, and this is another key contribution I think we made to the REIT world and understanding. I have some background in derivatives, and I knew that the variable of volatility is something that can be captured in derivatives. Real estate was mostly bought because people didn't want volatility. And this was, the volatility of real estate as a stock, a REIT,
Mhm.
was greater than the perceived volatility of real estate in direct form, whether it's an individual property or whether it is a passive holding in, for example, a fund, a partnership.
Which of course is still the case today.
Always will be.
Yep.
So the perception of volatility was sort of this funny thing happened. We were in the REITs, Real Estate Investment Advisory Council, and one of the other guys, Mark Howard Johnson, who was, I think, at Goldman at the time, and he said, why is the volatility, the beta of the REITs creeping up? It was historically it was 0.6. It was somewhere between a stock and a bond, and it was almost boring. It's like watching paint dry, right? Had crept up, and now it had crept up to 1.25. And we say, why are these things volatile? And they said, oh, not to worry, no big deal, Uh, well, comes the financial crisis. All hell breaks loose. As I mentioned, the REITs were down 80%. If you looked at the NAREIT index, it went from 1,200 to 200 something. The volatility skyrocketed. The volatility in the measured as beta went up to 3. And meanwhile, the volatility of the overall market had gone up threefold. Literally, the volatility of REITs went up tenfold.
Wow. Over how long? Over what time?
Well, this was during the financial crisis. Markets were in free fall, but the REITs were freer and fallinger. Okay. And why? Well, because the REITs, from an index standpoint, and someone with a background in ETFs, about indices, were bound together as part of the finance ETF, the finance index. So, basically, Simon Property Group, whose business model was very different, they were the biggest REIT at the time, very different than Citibank, but it's a much smaller entity, was lashed. The REITs were a small part of this finance industry, but the finance industry was disintegrating, and the REITs were like taken down. They were like going down with a ship, even though
wow. So they just got lumped in, and then it was all one trade, one correlation, and.
But it was the point being that it was what they were associated with, not what they were. And this was
right.
So the result was what triggered my focus on this was that the SEC puts out an inquiry. So, well, we're thinking we should get rid of the uptick rule for selling short. So, well, why were they even asking the question? Well, it seems that in the mid-90s, and I tip my hat to you as an ETF expert. These guys had this crazy idea of having an S&P index that you could trade on the exchange. They call it an ETF. There were 500 stocks. What to worry? And of course, 500 stocks, if one of them if you can sell it without getting an uptick, it's not going to move the needle. And we need to be able to operate in a manner that we can keep the value of the index and the value of the stocks in the portfolio linked. So can you please relieve us from this burdensome task of having to do an uptick? And they asked, oh, well, we like to spur innovation, whatever. So they granted it. Well, Wall Street being Wall Street, they came back. Well, we'd like to do a segment fund. They kept chopping it up smaller and smaller. The precedent having been set, they created this plethora of index products where you didn't have to observe the uptick rule. You only had to observe the uptick rule if you're doing an individual stock. The guy says, I don't need to short the whole stock. I just short the relevant index,
Right.
which they did. In fact, when we looked at the finance industry, there were more short than there were long net on the ETF. And of course, looking at it arithmetically, Simon Property Group was 100 times more shorted than, I don't know, pick a stock, IBM. So we did a study. We took it to the SEC. This is what you've done, SEC. You cooked the frog slowly with your abandoning of the short sale restraint, which they had put in the 1930s during the Depression to avoid short attacks. And now that it's gone so broadly, you have a situation in which you don't need to short individual stocks. So you've almost made it redundant. Oh, by the way, you've created these 2 times levered long and 2 times levered and now 3 times levered long or short ETFs.
Yep.
And literally, so we went to the NAREIT said this is important. We went together with NAREIT, with someone from Cohen & Steers, someone from Sanford Bernstein, 3 of us, and we testified in front of the SEC and in front of the Federal Reserve. And we explained how this approach was creating serious problems. It's exacerbating volatility. I think in one day in December alone of 2008, the entire REIT index went down something like 15 points and 50% in one day.
Wow.
Well, the outcome of that, to NAREIT's astonishment, was that they put limits on the further issuance of leveraged ETFs in REITs. And that, they said, we have testified a million times, we've never gotten that kind of response. Now, once the crisis was over, 2 things happened. Once these things mellow out and people moved on to other stuff. But significantly, in 2016, the equity REITs were segregated from the financial industry index. It was an acknowledgement that they had achieved scale. It was an acknowledgement that their business model was completely different than most of the financial entities. The mortgage REITs, interestingly, were kept in the index of for financials because they are financials. But that segmentation was made. And of course, so now REITs are much more measured in and among themselves. Now, there's not a lot of differences within REITs, but they're no longer tied to the banking system per se. But those were some of the lessons learned going into and coming out of the financial crisis. If you're going to go through a terrible experience, hopefully at least you'll learn something.
Did our regulators learn anything? Debatable. You sent me some great notes on lessons about entrepreneurship from the whole experience with EII. I was telling you, I kind of transcribed it. I wrote down here some notes for myself for this conversation. I wrote down lessons about leadership because I think some of them are entrepreneurship, some of them are leadership. They're really both, and I think you've really embodied in your career both. So I want to ask you about a couple of them. One is you said the business program that you start off and doesn't pan out, but you only find the path that does by the virtue of being in the market in the first place. So what do you mean by that?
Well, so again, let's go back to the history of EII. We started out with an appropriate, for what our backgrounds were and our experiences were, game plan. We're going to work with this bevy of investors who have very specific needs. There's not a lot of them, but we were credible in and among them. We could work across border and we could work in different assets, either one of which would have an unusual capability, never mind both. One of our board members, Corbin Day, who was a Goldman partner, whom we knew well in the corporate finance area, said, you're really not distinctive in corporate finance, and you're really not distinctive. I mean, okay, in general equities, yeah, but there are a lot of those folks. And the more we did this real estate thing, the more he was encouraging, says, take something where you're really distinctive and make that your focus. the point there was, it's not that our original business model was necessarily a bad one and that we might not have exceeded, but what you want to find in any enterprise is a distinctive competence that you can leverage. As the REIT thing began to grow, and remember, we managed it separately, we began to say, gee, this is really something. And plus we found that we have some influence there where we're not so much in the other cases. And so over time, we focused our business more and more until ultimately we got out of the corporate finance business and we turned that into a direct real estate business. So by the way, we were investing in direct real estate as a trusted advisor during this whole time, but on a smaller scale. My point being, if we had not been doing what we were doing, we would not have come across this whole REIT thing, never mind being able to catalyze it.
Yeah.
So very often the business you start is not the business you end up in. Frankly, no business is what you end up because business has changed generally, but the real opportunity is something you come across because you're out there in the market knocking your head against the reality of and that's how you find the real opportunity. If you were just sitting at your desk doing something else, you wouldn't have seen it coming.
Yeah, and I would submit, I mean, as you know very well, that Armada is a perfect case in point. We started with an ETF, first one, now two ETFs on REITs, and because we're out in the market, it gives us an opportunity to meet Ronnie Appel and Asaf Zivi and the team at Arrialgo. We've now merged, and we've the AI and machine learning models that they built for valuing REITs is a core part of our business. On the institutional side, it's in fact the largest part of our business. That's a pivot from where we started with the ETF, but without having just said, all right, we're going for it, we're doing this ETF, we're starting, we would not have been in a position to have been introduced. We would never have met them. We wouldn't know. We wouldn't have found the opportunity at all. So you kind of got to start, and it seems, like water finds the lowest level, right? Like once you're in the game, once you have a seat at the table, you'll find that opportunity.
Well, I think it's a perfect parallel, Phil. And so, if at first you don't succeed thing, you see, but it's not that you're doing even succeeding. It's just that you say, oh, look at this other opportunity. Now, along those lines, I think it's important to understand the role of innovation. And we were on both sides of that. You talk about being the disruptor. That's all. I'm going to disrupt this. I'm going to disrupt that.
Well, that's my next question. That you said it's more fun to be the disruptor than the disruptee, which I thought was great too.
Well, here's why. Okay, so if you succeed and you build assets and you have a team and you're out there trying to generate the alpha of the it's a never-ending cycle. You stop one quarter, you start again. There's inevitably a propensity to take your eye off the ball, and the world doesn't stop. It matures, and that actually is why capitalism works. If it's a good idea, somebody else wants to do it a little cheaper, maybe a little better, and it gets harder and harder to differentiate. But the point is, if you're the incumbent, you become the disruptor because somebody else is out there innovating. You can look at other industries. Look at IBM and Microsoft. Happening before your very eyes. Google, which became overwhelming, is suddenly being disrupted by ChatGPT. So every industry goes through this. So we were part of that. And also you get older, you get a little more set in your ways. 15 ways till Sunday. Once you're starting to lose the innovation thing, you begin to be vulnerable to being a disruptee. Now, what we did not see was the rise of ETFs. We did not. We saw it, but but that grew enormously for very good reasons, which you were certainly privy to and been a catalyst of. Even more recently, starting in 2016, we saw the growth of the non-traded REITs, which were basically a better version of a very poorly structured and financed non-traded REITs that preceded it. REIT specifically, and they grew, 120 billion, and that's an enormous amount of asset growth. So these two are examples of things that were disruptive. It's interesting to note that active managements of REITs today is down to like 5% of the total. Now the overall total has grown, but the market share of the institutional oriented active managers has shrunk enormously, and that's because they became the disruptee. But yes, to your point, it's more fun when you're growing it than when you're being, when you're the other side of that trade. So Armada's at the front end of that, we hope. And this is where I want to quote you, because I think you have had a very keen insight, and you helped me to focus the notion. You cannot you need technology to disrupt an existing industry. Now, that is a very cogent insight. The technology that we used was at the time, it was financial technology. It's not that we were better on a computer or something like that, but it was the financial structuring of and the ability to read the tea leaves, of managements and things like that. That was the form of technology. It's rather broadly defined, but it was. And by the way, the idea of the REIT was a financially different animal, and the syndicators and the other things that were the incumbents. So we were using technology to disrupt an industry. Today, with AI, I think that is clearly the thing that has garnered enormous mindfulness about innovation. It is it is not, mostly people don't necessarily think about it in real estate terms, and this is where I believe that Armada has an edge, because they are bringing that to bear, and that's where your point is, I think, spot on. Technology can be used to disrupt an existing industry, which has now gotten mature, and the differentials among them are different. And you've got, I think, an edge, and that's one of the things that excites me about Armada.
Well, I appreciate that. I think the next step for us is going to be not just having the technological edge, but explaining it and showing people, and connecting it with their everyday, why they need it, why they should care about it. And that's where, that's kind of our next area of focus, where we haven't really gotten to yet. But other people would call that sales and marketing. But I, for me, it's not sales. It's not really pushing people out. It's just there is a net. If our stuff is as good as we believe it is, then there is a natural market. There are people who are going to want to work with us for that reason, based on the quality of what we're doing, based on the differentiation of what we're doing. And our job is just to explain it clearly to the target audience, and let the people who want to work with us find us. And that's going to be kind of the second half of 2024 is putting that in place at Armada. And you've been such a help with everything with the company. So again, I want to thank you. This is such a great story. Is there any?
Let me just add one thing, Phil,
please,
before we round this out.
Yeah.
The other key thing is the leadership, and your ability to attract and maintain like-minded people who share your vision, and how you treat those people, and the example you set. And so I think that's also key. That's a central part of the culture of any enterprise. I don't care what industry or what field. It's this is where business management, the vision, the drive, the implementation, providing growth paths for your people, because everybody wants to grow. Get out of their way. If they're good, they're going to want to grow. You're better to you create your own. I don't call it competition. Just create your internal opportunity. But this is the role of leadership, and obviously you need the resources to be able to attract them and to maintain them. But it's a critical variable in management, and those enterprises that succeed versus those that don't.
100%. Well, thank you, Richard, for your time, for telling your story. And thank you to the audience for your time and attention. We'll be back with a new guest next week.
Thanks for having me, Phil. Enjoyed the opportunity.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.